Okay, I'm here. People are writing me, looking for it. I'm just going to wait for everyone to show up. I'm here. Yeah, I'm talking. I wasn't talking until now. How's that? I'm going to I have to keep moving, it looks like. So YouTube did some sort of... people are chatting in it. Let's see if people can find... Yeah, you just need to refresh. I'm writing people. Like, I could start another one. Like, anyway. Let's see what happens. Something happened in YouTube. They did something. They did some update of some sort and changed things on me, on us. Okay. So I'll wait till I have at least 35 people. Usually there's 36. So I'll wait. So sorry I started late. I'll end a little late. Let's see, some other texts, some other people wrote me. Let's see what happened. Hi, 14 in. We got 14. Let's see if everyone can come over. People are complaining. Okay, some people are in. Okay, just refresh. I'll send a note for people just to refresh the page. I don't know. YouTube changed things on me, and this is how it goes. Working. 14 of you are here. Sending some sort of image, or it looks like the live stream shuts down if I don't. Gotta keep talking, gotta keep sending data. Going to send a message to everyone and let your classmates know, if you guys have a chat, that this is happening. I'm just writing a text. Not text, an email. I have such a lot of announcements, so I want to make sure everybody's here. So refresh page to join chat and stream. Okay. Big apology for this happening. So you guys see what notes we're going to look at. This is 5 point, what do I call this? This is 5 risk and return, 5.8. So this is 5.8. All right. Uh-oh. Now it's giving me that message again about video streaming. I don't know. The messages I'm getting. 20 people in, okay. I don't know why that's happening. Okay, I'm going to double check with the people in this household what's going on, because I'm getting the same problem I had in the first week we started, okay? Give me a minute. All right, let's see how this works. Okay, and I only have, okay, people are coming in. Let's see how this works. If I have problems with the buffering, I'm going to have to take about a 10-minute break, and we're going to reboot the whole system on this end. I really apologize, but that's the way it goes. Okay, and at any case, I'm going to keep streaming. If you guys have to go, that's fine. I'll just finish the stream. All right, so I want to make some announcements. First of all, last week's Thursday video somehow lost the first 30 minutes, and then because of maybe we got cut off or something happened at the beginning, anyway, we lost the chat. So we lost those two things, and I salvaged the video and I put the new video in the playlist so you guys can review the new one, which has the first 30 minutes. So that's my best fix, but I lost the chat. And I'm not so concerned about the chat. That's almost just for us. It's nice to have in the video, but I'll say things and I'll also type them when they're important. So make sure you see that video that says full video. Okay, so make sure if you didn't watch last Thursday, I'm going to make a note. Watch July, it was July 30th, was it? I don't even know. It was July 30th, full video to see the whole thing, okay? Because otherwise the first 30 minutes were caught. And then that took time to put up, and I didn't end up doing the timestamps on that. I apologize. So I've got to put those up. About the final exam, I have some news about the final exam. The other class has done an open book final. So I'm going to do an open book final, no respondas, and no camera, of course. Okay, no camera, no respondas. It's open book, but it is 3 hours, so you only have 3 hours for it. It's going to be on the computer. It's not, your final answers will be posted. And it's going to be on August 17th from 9 a.m. to 12 p.m. So I think you guys should be happy about that. Okay. Now the assignment. So some people are still asking about the assignment. Faizan is asking, right, if you have less than 10 questions to answer, you have to do at least 5 correctly. I need the correct answer, right? Some people they found errors in the problems, and I've sent them to the administrator of my lab finance, and I haven't heard back, probably on holidays. So I'll have to just look at that and make sure you get the points. Okay, so do more than the minimum 10 for each chapter and minimum 5 for chapters with less than 10 questions. Do more than the minimum, okay? So then you can guarantee you get full answers. I don't have any practice finals. I'll ask about that. I don't have any practice finals to give you. I just have my questions. So I'll see if I can get some practice finals, okay? I'm writing it down. I have a meeting tomorrow to set up the final exam because I can't seem to do it myself. I tried with the instructions. So I haven't even seen the final. But as I explained to you, I've been teaching this course for 20 years, so I'm sure you're getting the material that you need for the final. Remember that I'm giving you, in lectures, I'm giving you a boost, but really you have to follow the chapters and read and do the exercises in My Lab Finance for the final exam. Okay, I'm teaching you. I'm teaching you that I'm highlighting, accentuating the important things. All right, so I'm feeling like we're behind, and I really need to get it going with the lecture. And I guess I can stay back and answer questions maybe during a break or at the end. Or I think I'm probably going to add another class at some point, or just like a well, my classes aren't mandatory, but I'll have a question and answer session about the final later. All right. Yeah, no part answers on the final. I'm sorry, but that's the departmental way. There's no, I don't believe there's part marks in the final exam. So this ensures, it's some sort of continuity in the course that we have a departmental final. And notice you get a lot of opportunity because 65% of the course is not the departmental stuff. It's just from the class. So you're probably going to be okay if you get through. So the test two average was 69%, which is okay. You guys are still learning. You gotta work on that stuff, okay? You gotta work on that stuff that you got wrong. I will be sending the answer key and the grader. Oh, I have to tell her to send each of you your results. I'm gonna write her right now. Give me a second. Let me check the stream, how the stream's doing, because it was buffering before. Looks okay. I don't know why it was doing that. So let me write the TA. So you had a different grader than the first test, and she did a fantastic job. She finished yesterday. I mean, they're both fantastic, don't get me wrong. I'm just saying this one finished yesterday, and I'm going to ask her to send the test result. The graded test. All right, there you go. All right. Chen Yang is asking, wait, let's see. Muskan is asking, is it multiple choice or enter answers? I think it's a mix of those two. Chen Yang Li is asking about the final. Do we have like options to choose from? And I think some questions will be multiple choice and some will be fill in the blanks. And then, yeah, I think it's going to be like that. But I'll tell you more when I see it. I haven't seen it, okay? All right. So we have a test 3 on Saturday. And tomorrow you have your latest assignment due. So let's see if we can get through this material. And then the TA will help solving the problems. I have more exercises to send you after today. Let's see how much we can do and how much you guys can catch up. I think you guys are doing fantastic. Let's all remember this is a condensed course. This is unheard of. The schedule is almost insane. The number of hours we're putting in for this course. Those of you who have taken another course, I do feel mercy for you, but you still have to get through this stuff. Anyway, the bright side of this is that you finished Finance 2200, which is amazing to finish it before the year starts. So that's the bright side. Let's just get through this together. We have 2 more weeks together, and then you're going to have a week alone, but I'll be there. I'm actually leaving. I'm returning to Puerto Rico on Saturday. I won't be able to use my phone anymore because it's I have an international phone number. I'll give you that number, and now you can reach me by email anyways, so we can be in touch. And my lectures next week will be from YouTube. They'll be on YouTube, but they'll be from Puerto Rico. All right, so we have really 3 more weeks together, okay? And just keep at it. It's the same idea. You've got the idea of how this works. You'll see in my answer key what I expected. Some of you, it looked like the exams that I saw, it looked like that the people whose exams I looked at, they did a good job presenting their answers as I have been demonstrating and as I provided in the answer key for problems I've been sharing. All right, so just stick with the pattern. Remember, the final exam, it will be open book, no respondus, but it is 3 hours, so you got to be organized. You have to have everything organized, have your your formula sheet nearby, okay? Have your papers organized. That's my recommendation to you. Have your problems organized on a table, and no interruptions, of course. You're going to have to find isolation for those 3 hours, seclusion. And the best way to prepare for that is to practice in the next couple of weeks at finding some quiet space and answering these problems in the same way, all right? Giving yourself so many hours to study without interruption, and then looking at answers to see where you're going wrong. You have the TA to help you on Wednesdays, and then you can also send me questions. Okay, so let's get started with a discussion of Module 5. So what I did last class was the review of statistics, and I'm hoping it was a I'm hoping that we benefit from the investment in time. Like, I've put time into that. So let's see. We begin the discussion of risk and return with a discussion of what returns are. So before I go on, do you want to ask me any more questions? Because I just feel there might be a couple more. Let me give you a minute. Any more questions before I begin the class a half an hour late? No? Okay, good. I hope you're happy about the final. I am. So I want to just step back. Tanner is asking, will the exam be tight? I would guess, I'm totally guessing because I haven't seen the exam. I would guess, based on my previous experience, that it will be tight. It will be tight. You got to be very organized and very prepared, okay, for that final. But I'll give you a better idea once I see the exam. Tanner, you'll have time to think. I mean, you get all your materials, but you're not going to be able to be learning. It's not going to be like right now where you have 6 hours, okay? So it's going to be tighter than the 6-hour window I'm giving you. So you need to know your material. So if there's things that you feel shaky about, go back and develop a confidence about it, okay? All right, so this is what we talked about last class, and I want to just step back. So we talked about financial returns, okay? So when I gave you numbers like this, and I talked about creating statistics. Oh, do you guys see this? Oh no. It's frozen again. Ah. So let's see. I gotta reboot this. I have lost the signal. I lost the signal. What has happened? Terrible. I'm here. You can hear me, right? My Wi-Fi. It's frozen. You hear me, but you still see 5.8. Oh, I lost the Wi-Fi. Okay, it's coming back. I'm rebooting my iPad. First thing I do when I return to Puerto Rico, when the stores are open, is I will buy a new iPad. I couldn't buy one here because in Puerto Rico there is no Apple Care. Anyway, if you know anything about Apple products, I wanted the insurance. Okay, you guys see the new boot. So I apologize that I don't have the new product, but it just was not easy. All right. Great. Things are working again. Okay, so this is what we talked about last class. Let's focus. And I presented to you variable X and Y, and I told you the X will always be the market returns. So some measure of risky assets, market portfolio we call it, or economic. It's an indicator of the health of the economy. And BCE, this is an asset. So this is a stock, an asset in the BCE company, Bell Canada Enterprises. And these numbers are what we're going to talk about right now. Where did they come from? So we're going to take a step back and we're going to discuss where they came from. How many of you actually read these notes? I asked you to look at the notes, or did you just have a nice weekend, long weekend? You can let me know. Don't be shy. It just helps me gauge how slowly I have to go. So, how many of you actually read these notes? Who can honestly say they read these notes? 32 of you are here. There are 58 people in the class. So that's pretty good. Okay, you read over the notes? Yes, so yes, and did you understand them? I guess that's a better question. Okay, you had fun? Good. I'm glad you had a good weekend. You learned a lot last week. It's good. It's important to be fresh. Take a break and then come back and focus. Okay, thanks for your feedback. Okay, so we're going to talk about where those numbers came from. We begin with an understanding so I'm going to talk about returns on stock, okay? Returns company stock. So returns to stock have a dollar return. So if you're holding a share in a company, each share has a dollar return over time. So we're going to use T, the subscript T for today, you could say. Okay, so T for today, you can think of it as time, but we can think of it as today. Make it easier. And so a dollar return today, so this would be, actually I should put a subscript here as well. Dollar return at time T is equal to the dollar return today plus a change in market value. So market value is the price, the going price, what you can sell it for. So you can sell it for PT, but last period, whatever that was, last week, yesterday, or a year ago, that's PT minus 1. So don't let these subscripts bother you, okay? They're meant to communicate. We want the difference in time. So this is the dollar return today is equal to the dollar return we obtained today. Sorry, the dollar dividend, did I say it wrong? Dollar dividend we obtained today, plus a change in market value. And that's calculated between today and last period. All right, that's what it means. So you can say this is today and this is yesterday, if that helps you. Oh, it is frozen again. Muskan, you're right. Oh, me too. Oh, what's happening? What is happening? Why is it doing that? It's probably because I didn't do my update. There we go. So I'm rebooting again. It's coming. It's coming. Okay, let's see if this lasts. I'm looking down at my iPad and I still have to look up. All right, now you see my notes. All right, so this is historic ex post returns. We calculate returns as the dollar return today, which is equal to the dollar dividend plus the change in market value. What's the change in market value? It's a change from yesterday to today. So T is today. You can think of T minus 1 as 1 period ago. I won't write it down because sometimes I'll call it yesterday, sometimes I'll call it last year. Okay, so that's just 1 period before. Everybody see that? So that's important. Now, that's nice, but we, in statistics is about averages and relative measures. Relative measures would mean I want the return relative to something. So this is the dollar return relative to the beginning price would give me a percentage. Okay? So that is, let's just jump here. You see what I'm doing here? I'm taking the dollar return and I'm dividing by the price last period. So now this is a relative measure as a ratio. I'm getting the benefit today over the cost last period. So this is a relative measure of how I'm doing. This is giving me now RT. So this is our variable of interest. So all of those, let's just save that. All of these numbers are RTs. All of these numbers here. This one is R. So this would be like R1 for market. Is that okay? And this one would be R1 for asset. You see that? And this would be R2 for market. And this one would be R2 for asset. So I'm giving a lot of notation, but just because you're going to see this, I'm warning you. That's what these are. Got it? So going back to that, if I keep tapping the screen, it's more likely to stay active, I think. All right, so that's what this is. RT. Are you guys good with that? So this is our first formula. Or let me do this. So put that on your formula sheet and you're going to get practice with that. If you saw the exercises that I gave you, the problem set I gave you, I'll give you some more, but the problem set I gave you had exercises to rehearse this. Another way, so this is just the dollar return over the initial price. That's how you can refer to it. That's the initial price. So some people are really good with the notation and some people are really limited by the notation. It's just another language. And it takes time to learn a language for some people. I'm not the greatest with languages. I speak 4, but not very well. I can communicate, I can read, but it takes me time. And so I take a lot of time also. I guess my 5th language is mathematics and statistics, that I can read this. But I encourage you to try and interpret these in your way, okay? And then confirm with me if you're interpreting correctly. So this is, last time, is the dollar return over the initial price. You could write it like this as well. I don't know, some people can think of that as easier to understand, minus like the principal amount. So this is per dollar, right? So this is your return minus the principal. So for each dollar, that's the return. So that's one way to write it. But this is a common way. There's a convention to see this portion as the dollar, sorry, this is the portion that's the dividend yield, because this is the dividend over the initial price. And this is the what's called the capital gains yield. So this is the percentage return or percentage change. So I can write this another way. I could say percentage change, where the triangle means change. That says change. Okay. Everybody okay so far? Because I'm going to spend some time on this. Okay, so the dividend yield plus the capital gains yield. So this is really important. These numbers, these measures are really important. This shows growth. This is so for each dollar invested. And this shows the dividend yield. So remember, from our understanding of holding a stock, you might not, as a stockholder, get a dividend. So this might just be zero. All you're getting is the capital gains yield. It's important to realize that. But this is the potential returns on holding stock or equity in a company. Okay, it's referred to as equity as well. Okay, so I made a note on the next page. This is percentage return. So if you ever want to compute percentage return, remember this formula. Now you'll see this in economics, you see this in finance a lot. Remember new, okay? It's new, the new number minus the old number divided by the old number. So it's always the change on the top relative to the original or initial value. And that could be for any variable. That could be changes in prices of any kind of asset, not just stock. It could be change. This could be the change also in the market value for holding a market portfolio. It could be the change in the price of a building or in any kind of index. It could be the change in interest rates or returns. This is how you do it, okay? All right, so now I want to talk about something related. This is the formula I just showed you right here as the dividend yield and the capital gains yield. And I'm going to write that in a slightly different way because what a return is, I'm writing it as R. What a return is something we've already seen before. Even though I've shown you a new formula based on your understanding of what you've learned about stock can return a dividend, and just by holding it, whether you sell it or not, you're holding, an investor is holding the market value. So a prospective investor, someone looking at purchasing stock in a company, will see this as the return and use it to value stock, okay? They use this information to determine whether they want to invest in stock or not. So this is in one time period. So the return is like a type of interest rate, right? Now, notice, as I said, you don't have to actually, as an investor holding the share, you don't actually have to sell it to realize capital gains. I mean, yes, you do, but the point is that you're retaining the market value. So this R is like a return, like an interest rate is a return over time. You can see at time 0, if we see this as a time, at current, you can say this is the now. The return I get next period could be seen as the dividend, or return in that period. No, let's see. Let's wait. Let me clear that. Because so what I've done is said, let's see the initial price as the initial price. So there's the now, right? Let's put it there. That's the now. Sorry if I messed up your notes. And the dividend received over the period from initial to the end of the first period would be like C1. So this is like the coming cash flow. This is, like I told you, it's the percentage change or a growth rate. So this is like a G. So it turns out that RT, if we make an assumption that over time the the capital gains yield assume the capital gains yield is the same. So assume capital gains yield is G. Always. Notice, because of the subscript, that implies that it can change over time, okay? But I'm going to assume it stays the same. The capital gains yield, the growth rate is always the same. The dividend coming is going to be the first one coming, and will also stay the same. Well, no, I shouldn't say that, because what the first one, so the first one will be C1, and then they will grow at a constant rate G with the initial price PV0 Notice that you've seen this formula before. I can rearrange this and show you that the assumptions that we made for the growing perpetuity for valuing equity or valuing stock. So for stock valuation, often I would tell you this is the first dividend or last period the dividend was, and you have to figure out the first one coming if you were to purchase stock now. I tell you that the growth rate was constant at a rate of G, and you would use this formula. Well, what if I don't have I? So what if I have information on G, the current market value, the price, okay? And I have some information about the coming dividend. I could solve for I this way, you see? Why would I do this? Well, that's very realistic. So remember, I present to you abstractions, I develop formula, and then or theory, right? From which we derive formula, and then I make things a little more realistic. It's very realistic that I have the price because I can observe what people are selling and buying stock for today. I can look at announcements and anticipation of how the company is growing or not, could be declining. I can read prospectus from a company about the dividend that's coming next period. I can make assumptions about the growth rate as a result. And I could calculate I. This has a special name. This is called the dividend growth model. And what I'm trying to tell you is that this formula that I've given you is a more general case of this specific set of assumptions. Okay? Remember, this formula comes from this formula, which was what? Something we learned that we could use for valuing stock in certain situations. When we know that the growth will be constant and we know the first cash flow coming, and we happen to know the required rate of return for investors in this company. We can use this algebraically, solving for this and basing it theoretically on this general understanding. Okay, so there's a relationship between these formulas. This is the more general one, and this is the one you already know. So what I'm going to try and do is as an overview of where we're headed. You learned time value of money. We learned about valuing cash flows. We learned about projection of cash flows and how, using a case example as an example, we learned how to determine what are the suitable or what are the estimated cash flows over time. And then using either IRR, like any of the techniques, IRR, NPV, profitability index, all these different techniques we learned, we're able to value projects. We did all of that while I would have given you the required rate of return. So we have, remember, we talked about required rate of return, for valuing stock. We talked about yield to maturity. Well, no, let's say we could also call that cost of capital. Okay, these are all the same sort of term for valuing returns for a company, for a corporation. So required rate of return, cost of capital, cost of equity. These are all the same thing. Hurdle rate, you might have seen this. Any other terms you guys have seen? There's another one. Known as the weighted average cost of capital, or WACC. So this is where we're heading. We're going to learn how to calculate these. These are all the same thing. The final is in Learn. Some people are asking. These are all the same sort of thing. I want to find the required rate of return for investors in a company, investing in a company, in a corporation particularly. That's also the same as the cost of capital. It's the same as cost of equity. It's the hurdle rate, and it's also the weighted average cost of capital. Those are all the same thing. Okay? So Senna is asking, why are there so many different ways? Yes, there's slight differences between these terms, okay? So required rate of return is just more general, but if I mention cost of equity, this is specific to stock. So this is specific to the stock in a company. But companies aren't necessarily just financed by stock. Corporations can also borrow from bondholders, right? So people who loan money to the company, they receive a certificate of indenture, that is a bond certification. Like, so they have a bond like they have a commitment from the company or the corporation to either pay them a coupon at set points in time, right, at a certain rate. So there would be cost of equity. So if a firm is just stock financed by stock and no debt, we would refer to the required rate of return as cost of equity. Cost of capital includes both equity and debt, as does the weighted average cost of capital. Okay, this is for an equity and debt financed firm. Now, I know some of you are not finance students, so that's why I go a little slow with this. The students who are in finance might find I go too slow with this, but I'm trying to resolve problems with the average student. It's a little bit between those finance fields and other fields. So my target is for people with zero knowledge of finance. So equity and debt financed, to put those together, the cost of equity and the cost of debt, we calculate the weighted average cost of capital. And then this is what we would use. So I'm going to teach, this is where our goal, this is where we're heading with this, okay? How do we get that? How do we get there? So when you think about it, what we're doing is finding I, or determining essentially for the firm, for investors in the firm, and for the firm. And you'll see that's what it's the required rate of return for the firm, because the firm has to pay this out as a return to investors. It all makes sense by the end. All right, so this is where we're heading. So let's see. Let me just take this down a notch here. So this is known as the dividend growth model. So when I refer to the dividend growth model, you should have information on the dividend coming, the initial price, and something about the prices to calculate the growth rate. Or you might have information on the growth rate, and you can use this formula. Okay. So let's try one. So I give you this exercise. Take some time to work on this. Okay, let's see if you can fill that in. So here's some information. Suppose a stock had an initial price of $42 per share. It paid a dividend of 84 cents per share during the year and had an ending price of $46.20. Calculate the percentage total return, dividend yield, and capital gains yield. So do that. Give you a couple minutes. But you can put your answers in the chat. Just waiting for you. Put your answers in the chat for A, B, and C. Spencer looks good. Yes. Leonora, I'm not sure how you got those numbers. Double check. Okay, yes, you're getting the answer. Very good. So let's do this efficiently. I'm going to do it in pieces, which is much easier, right? Because percentage total return is just the dividend yield plus the capital gains yield. So dividend yield is the dividend over the initial price. So you see I'm using this notation. You don't have to, you can just, as long as you understand, right? You don't have to put the formula in. Those are just to guide you in my notes. But you do have to show me the numbers with the form, like the numbers inside the formula. Suppose the stock is initial price. So this is P0, where 0 is, you could say, Well, we can talk about going over the period. So at the initial, I could say is 0, or I could use t minus 1. I could do that too. Maybe that's better. Paid out dividend per year. Anyway, this should work. Paid a dividend of 84 cents during the year. So we'll say D1 is 84 cents. And then P1 is the ending price. Okay? Or you can use T. No, I don't want to do that. Let's just do it like that. All right. So then this ends up being 84 cents divided by the initial price, which turns out to be 2%. And capital gains is the change in price, so the new price, right, minus the old price divided by the old price. So get into the habit of doing that. So that's going to be, what is the old price? Initial price 42, so that's 42. This is 42, and the price, the ending price was 46.20. And you end up, you can put as percent or decimal. You should be comfortable with either. I accept either, unless specifically I tell you to mention it as a percent or decimals. Okay, I will accept either. So this is when you put this together, you get 10%. So then you can add. This must be 12%, and that's it, because that's part B plus part C gives 12%. Is that too messy? I apologize for the messiness. It's really hard on my old iPad. Okay, so get into that habit. Capital gains, new minus old over old. Dividend yield is just the dividend over the initial price, and you add them together to get the total return. We've had a healthy stream for almost an hour, so I think this stream should work out just fine. I can't promise we'll have the chat at the end, so if you have any questions, you're going to have to email or put them in the comments, all right? Alan is asking, is this for common shares? Exactly. And I should specify, this is for common stock, common shares. All right, so because the fact that, I'm going to save this and go back to these numbers again, trying to tie, synthesizing all the notes so things don't look like they're new. They just are more generalizations as opposed to precise examples. So what I expected you to do over the weekend, other than finishing the test, is to familiarize yourself with the formulas, to be confident with the formulas that I gave you. Now, these were for ex post or historical data, right? We talked about these returns. And notice returns don't stay the same, right? They change over time. And similarly for the asset, it changes over time. Even though we used it as in some problems for valuing stock, I assumed that there was no growth, right? That the stock, the dividend was always the same. But these are showing that the returns for common stock in this company, or this could be whatever share, BCE's shares, were 30%. So it changed over time. it doesn't necessarily have to be at a set rate, or the return is not the same throughout. This is really important to know when you want to figure out over time what is the average return for a company over time. So we want to figure out what that is. We begin by talking about, see, these are different returns here. I want to see what if I invest $1 now. Actually, this is for historical, so, or it could be any actually. If there's a set of returns, the example I gave you was historical data, and the important point about that is each of these returns have equal weight, equal significance, add equal information to my data. For $1 invested, what is return over time? So this says for $1 invested, find the percentage return over time. Now you can do that over the total time, T. So this can be for 3 years, 1, 2, 3, or 5 years, 1, 2, 3, 4, 5. And you want the percentage return. So you're going to use the factors, right? We talked about this. This is like compounding. That's all it is. It's 1 plus the return. Where the returns change, you have to do 1 plus R2 times 1 plus all the way to RT for the duration of the investment, and then subtract off the principal, the $1. So this is for each dollar. So this is called the holding period return, and we're gonna carry out an example. How about if I want an estimate of the average return each period? So for all these periods, what on average was the return? I could figure that out using the geometric average return that I presented to you in my statistics review. How would you do that? Well, return 1 plus return 1, that's the factor of accumulation for the first period, times 1 plus R2, that's the factor of accumulation for the second, all the way to the tth period. Multiply those factors together, and then rather than divide by the number of periods, these factors are compounding, so that's a power effect. And we've seen this before. This is for periodic rates. That's what we did, right? We do the inverse function, and that would be dividing in the powers. So we are partitioning into bits into 1/10 of that time, and then subtracting off the principal for each dollar invested. So essentially this is just the holding period return plus 1 fractioned or divided into or partitioned into 1 period over that time, and then take off the principal. So that's a geometric average return, and you can compare that to just the regular average. Add them up and divide by T. These numbers will be the same if the data is symmetric. I have to say data. Data is a plural, so data are symmetric. If the data are not symmetric, which one should you use? Now, I mentioned that in financial data, we often talk about the market portfolio, which is based on an index, a composite index created from several top performing stock, and that appears over time to have a symmetric distribution. However, I'm just going to mention this. If the data are skewed, which should you use? GAR or arithmetic average? Anyone know? So my point is, if they're symmetric, these numbers will be the same. If they're not the same, it implies that data are skewed. So which one should you pick if the data are skewed? What do you think? I think you should think of what I told you. The average like this is affected by extreme values, right? So the alternative would be to use this one. This is a more stable measure of return over time. You're going to see that in the example that I show you. So the answer is GAR. So let's see. First, I'm going to present to you a historical event that occurred mostly impacting the United States and indirectly impacting Canada. Was the global financial crisis that was initiated, or that was caused by problems in the financial markets in the United States. Without getting into that, you can read about it in the textbook if you don't know. And I did mention there are some there's some good documentaries and even dramatizations, films, to watch about this and why it happened. And I did mention to you, maybe after the course, some downtime on the September long weekend, you can watch The Big Short or a documentary like Inside Job. There's tons of documentaries about what happened and speculation about why. Okay, so I recommend those. It's okay that you're late. You can watch the first hour and a half of the stream when you get a chance. Okay, so here are the actual numbers computed from 2007. The stock market crashed in 2008. The S&P 500 index is a measure of of performance, financial performance of these companies, these corporations. So let's see. 2007, the returns to the S&P 500 index, where investors actually invest in this index, or they're invested in a portfolio of stock and bonds, assets that mimic the market portfolio. Well, these are risky assets primarily. In 2007, the estimate of returns was about 5.49%, and historically that's rather low. But after the market crash, this is actually the market crash. This is a measure of the returns in 2008. It was in September, October. The returns were estimated over that year at 37 negative. These are percentages. So that means for every dollar invested over that year, 37 cents were lost. All right, so these are negative returns. It rebounded the following year with 26% returns. So this is double the average. You'll see that. I'll present to you the average, historical average, going back almost 100 years. So this is quite high, and then it leveled out in 2010 at about 15%, which is close to the overall average over the last 100 years. So anyway, these are very wild numbers. This is an extreme value for sure. This is kind of a balancing value. These are mediocre values. Well, this is mediocre, and this is about average. So there's only 4 data points here. But I want to know, if you invested in 2007 and you left your money in a security that mimics or that tracks the S&P 500 index, so it returns the same as the S&P 500 after some transactions costs, what would you get as a return after 4 years? That's my question. That will be answered by A, the holding period return. All right, so you could calculate that. I'm going to just show you because it'll take some time, but you need to practice. So practice finding these answers. But I will give the answers right now. So that's going to be over the whole period. But what about annually? So I want to know, if I invested $1 at the beginning of 2007, did I lose by 2010 if I left my money invested? That's the question. Then I just want a measure of the average return over that time. So the annual average, that would be measured by the geometric average return or the arithmetic average return. As I explained, if they're different, I should go with the GAR, okay? So let's see. Here are my measures. So look at this. After 4 years, if you invested, you did have a loss. I want to emphasize, practice entering these values in your calculator, okay? Because you need to remember this is a negative. You don't want to make that mistake. So work with that to make sure you can get this amount, negative 3.3%. So there is a loss in those 4 years. So this is from the beginning to the end. But what about on average, an annual return? Here is the result of calculating the geometric average. And you can compare that to the arithmetic average. The arithmetic average makes it look like there were positive returns each year. But we know that's not the case because overall there was a loss. So it's true that the geometric average would better capture that, wouldn't it? If you took this, it's 4 years, right? And if you times that by 4, that's closer to the total. I mean, you wouldn't times it by 4, but you would do this, right? You would accumulate by 4. You would get this number because that's the way it's calculated as factors. If you use the average, it would look like it was a positive, which it isn't. It's a negative return. You guys okay with that? Okay, Muskan's asking if there's any calculator function. So there isn't, but since the final exam will be open book without respondus, you can just do this in Excel. You can set up the formula in Excel to calculate this for you efficiently. If you don't know how to do that, you have time to learn, okay? So you can make columns, or you can just make a formula. You can have you can make a formula with equals and create a formula with the cells. So work on that if that helps you. But no, there's not in the TI BA2 Plus, and I don't think in the HP you have these functions, but someone can tell me. I've never used these in teaching the class in my calculator. Well, only this one, of course. You have this one in your calculator. This one being the average, the arithmetic average. All right, so I hope you got that. So as we discussed in our review of statistics, we don't just use an average. We would report an average with a measure of the volatility or the range of values when we're reporting statistics. So let's just have a look here at different classes of assets. What I have here in this chart, and I created these for the United States, and I have the reference here in the bottom. I have these different classes. I have risky assets as measured by the S&P 500. I have 3-month Treasury bill. These are government bonds. These are pure discount bonds. So you buy them up front and then you get the face value of the bond, which is usually $1,000 after 3 months. And then these are 10-year, this is the symbol for the 10-year Treasury bonds. So what do we see? Which are the most volatile? Which one has a lot of variation, a larger range in returns? So the returns are on this axis, as measured as percentage returns. So you see the most volatile are the risky assets. Although they can have really high returns, risky assets as a composite have high returns. Unfortunately, they also can have very low returns, negative returns, not just low. Okay, so that's a loss. That's indicating a loss. And the second most volatile are the 10-year Treasury bonds, right? The dotted one. You see the dotted one through here. There's quite variation. The more stable, like around, closer or less volatile, are the 3-month Treasury bonds. So these are the returns over time. And I want to say a few things about here. One is that well, first I want to say, how do you calculate returns? And we learned about that. How do we calculate the variation or volatility of returns? That is calculating the variance, which would give you percentage squared, which makes no sense, right? So instead, we take the square root of the variance, and we call this the standard deviation. So for historical data, you should be comfortable with making this calculation, and you can put this in your calculator. So this is a variable for a variable of returns. You've seen this formula. We talked about it in the review class. And if I give you the data, you should be able to calculate this. As I mentioned, use the columns, right? So replicate the columns in the table here. This is for the returns, and this is for the average. Remember, these are the deviations, the average. So variance is the average of the square deviations from the mean. So that's the mean. You square them all the way down, and you take the average. Remember, because we use an estimate in the estimator, we have to adjust for degrees of freedom, and that makes this number, the variance, a little bit bigger, and also the standard deviation a little bit bigger than if we divided by 4. And that allows us to well represent the range of values, because it was found by statisticians that you needed to do that, to adjust for the fact that there was an estimate inside of an estimate. All right, so what did we get? We'll look at the volatility, 27.6949%. Now, what we learned about mean and standard deviation, if we use these as measures of returns, this is quite volatile, right? This is, if you think about the average being 2.5, and you add and subtract this amount, you're in the negatives right away. Right? If you think about, I want to make an interval. Right, so Kyla's asking, why are we using these numbers? Okay, because it's true that I shouldn't be using the arithmetic average, but I just wanted to finish making the calculations for the arithmetic average. In fact, the arithmetic average, and then obviously this regular standard deviation calculation. However, as we learned, the data are skewed and we shouldn't be using these calculations. So you're right, Kyla. So what I actually am going to do is, this is just for practice, okay? So you can practice making that calculation. What I actually do here is say we should be using the arithmetic average only where the data are symmetric. So what I'm going to do instead, because that was a very skewed distribution. How do I know it was skewed? Because the geometric average return and the average return were different. Okay, so I know these are indicating to me that the data are skewed. So rather than proceed with those numbers, what I'm going to ask you to do, first I want to mention this to you. So here I have different classes of assets. I have risky assets, US common stock here from the S&P 500. I'm going to take the data over, this is 80 years of data. Is it? So this is going to be from almost 1930, 70. So, yeah, it's almost 80 years, more than 80 years of data. And you see something here. On average, well, first of all, here's the distribution. So how would you smooth out this distribution? I'm on page 12. You guys are asking good questions. Clever. So I will smooth it out. Well, I have to do this with my finger because it's not very good with my pen. I'm going to say it's symmetric, right? So even though we had that terrible stock market crash, and there was also a crash after 1928, and there were other crashes, it turns out that over time, over 80 years, that it's roughly symmetric. There's really no data here. It doesn't look exactly normal, but we make that assumption. And when you so because it's roughly symmetric, I can use the arithmetic mean. I can use the standard deviation as summary statistics. All right? And now, with this mean and standard deviation over this period of time, I want you to draw, assuming normality, I want you to depict the market returns for the US as a normal distribution, and I want you to answer two questions. What is the chance of positive returns? And what is the chance that returns will be less than negative 30%? So I want to know the answer to these two questions. I'm going to give you 5 minutes to draw that, and then we'll work on that together. So you guys can take a water break, write some text, and also work on answering this for me. And then also your questions if I confused you at all in this presentation. Okay, let's take 5 minutes. I'm back. No answers? You haven't answered the questions. Anyone have answers for me? No idea? We begin by drawing. And so I've assumed what I've done is said, let's not just look at 4 years. Let's look at a range of years. And we understand that these data are symmetric because I've graphed them for you. And this is roughly, yes, it's symmetric. And more than that, historically, we could test it and we'd find that, that these data are roughly normal. So 68% of the observations are within 1 standard deviation, 95% are within 2 standard deviations, and 99.7% within 3. We can make that assumption. Here's the mean and standard deviation, which we'll use as the mean. Like I've rounded them just for ease of computation. And then I'm asking you to depict them here. So this is what I expect from you, that you can draw this, and then this is my rough graph, and then it's a sketch, and then 1 standard deviation, and I can say this is 2 standard deviations, and then this is 3 standard deviations, right? And do the same thing on this side. That's not really even, so I'll go here. This is when editing videos comes in handy, but I'm not going to edit. Okay, it's just a sketch, so you have to equal intervals. Okay, so that's my 1, 2, 3 on each side. Now what number goes here? In the middle, we have mu equals 11%. Right? Let me do that again. I'm going to do that, making it a bit bigger. So in the middle, I have of mu of 11%. One more time. So you should be doing this too. 11% is mu. All right. Now the first 1 standard deviation away would be 11 plus the standard deviation, which is 20. I rounded. So that's going to be 31%. So this will be mu plus sigma is 31% over here. And then on the other side, it's mu minus sigma. Are you guys getting the hang of this? Mu minus sigma, which is 11 minus 20. So what is it? So this is review. This is an application of what we already discussed. So this is minus 9%. Okay, so what I have is, sorry, that was off. That's here. So we're going to use this graph. So I've graphed it just because. Right, so right side is plus and the left side is minus. So I'm going to plus 2. Well, anyway, let's see if we can answer the questions and I don't have to do any more. So let's see. What is the chance of positive returns approximately? What is the chance that returns will be less than negative 30? Well, I'm only at negative 9. So let's keep going a bit. Let's try this 2 standard deviations away. So now I'm going to figure out this one, I have to take mu plus 2 sigma to figure out that one. So that's 11 plus 40 is 51%. And then on the other side, it's 11 minus 40, which is minus 29. Aha! So 11 minus 40, let's go over here. So this is going to be minus So with the limited information, that we get from just saying it's normal, without a table, without being precise, already I can answer the second question. What is the chance that returns will be less than negative 30? The chance they'll be less than negative 30 are represented by this area. So less than negative 30 is less than, it's less than this area here. What's over here? What is this area here? How much is that? Does anybody know? So that will answer the second question. And then one of the first one's a little more rough. Okay, so we know at 2 standard deviations away, so in between here, we know at 2 standard deviations is 95% between here and here, and that leaves 5% total outside of that. So if you're just in this region here, that would be 1 minus 95, well, let's say, wait, let me write 1 minus 0.95 divided by 2. Is that confusing? Because the total under the curve is 100. Between is 95, so I have to take that off. And then because there's 2 sides, I have to divide by 2. So the answer to the second question is 2.5%. So think about that. I'm going to write it down. I just showed you how to get it. Now you have to think about it if you didn't understand. Let me know if you get it. Even if you didn't calculate it yourself, but you understand what I'm trying to say. So within 2 standard deviations, I've pointed out that that's between 2 standard deviations would be between negative 29 and positive 51. Unless I made an error, you can let me know. So then if it's 95 between, then it's 5 outside. So that makes this one side 2.5%. So again, that's just me and my update. Right, because of the 2 tails. So I'm talking about just here. You see how assuming normality makes things quite easy. And it's not It's not a bad assumption. You could test it. You could take the data points and you could calculate how many fall within these ranges to see if it estimates or approximates the normal. It's really light for you? Here, it's just because I made them small. That's my calculation right there. Okay, so what you should be doing is writing this on your own paper and trying to figure it out. I'm giving you some time to do that. Don't just wait. If you want it thicker or darker, I can't really recopy it now. But what would you say with this graph that you've made in front of you? So you're going to have at 2 standard deviations minus 29. At 1 standard deviation minus 9. In the middle you have 11. At 1 standard deviation 31. And then 2 standard deviations 51. So let's see, what would you say about the first question? What is the chance that the returns are positive? Given just using this graph, give me an approximation. Right, so if this is where, so somewhere in between here is 0, right? And so positives are bigger than 0, but I don't know exactly where. I could, with the standard normal table, figure this out, or using Excel and a backwards approach, I could figure this out. But I'm going to say roughly, if I go all the way up here, this is like 50%, right? Because it's half of a symmetric curve. Yeah, you guys send us, yeah, it's very creative. Okay, so let's say, basically it's between here and here. So roughly, just using this, between here and here, this would be 50. And if it was here, how much would that be? How much would this be? So what I'm showing you is I want to go more than 1 standard deviation below the mean. So I probably should redraw this. Maybe it's hard to stare at. So this is, between here and here is all we have to add, right? So this is what? 68 divided by 2. So it's going to be this, which 68 divided by 2? 34 plus 50. So somewhere between 50 and 84. So someone said 70, which is fine. You know, approximately somewhere between 50 and 84. And say that. Are you guys with me? So between here and here is 0. And what I want to do is say, what's the chance of having bigger than 0 returns? Well, it's more than 50% because the middle is 11%. But it's no higher than 50 plus this amount. So if 68's in the middle, this little bit is 68 divided by 2. So my answer is going to be you can watch this video and write it out for yourself. The best answer I have for you is to say between 50 and 84%. So it's a large range. You probably want to do this using a standard normals table or Excel to find the exact value. So yeah, saying something, anything between there, like evenly between there or somehow between there, is I would accept it. Okay, so somewhere between 50 and 84%. Yes, Tanner, I just don't want, this is not a statistics class per se, so you would have to use your standard normal table and figure it out. But I don't expect you to do that for this class. Well, maybe they will on the final exam. So how would you find it? So you'd have to solve the problem. Oh, I'll use a black. So you solve the problem, probability x is greater than 0, and you would standardize it with the numbers given. So this will turn this into a z, and you would standardize 0 minus the mean divided by the standard deviation. Correct? So what are you going to get there? Z is greater than 11 divided by 20. So P of Z is greater than 0.55 negative. And then you got to look in a standard normal table or use Excel to get the answer. The close to is just the easiest thing. If you're picking between alternatives in like a multiple choice question, this would give you a rough idea of which one to pick. If you were given a standard normal table, then you could actually get the real value. Or you can put that in Excel and ask Excel for the answer. Okay, there's probably in the textbook, I have the textbook here, let's see if they have the standard normal table. Again, this is not a stats class. I did the review because you're assumed to know that material, so you should know how to use a standard normal table. I don't see one. I don't see it, so probably that's fine. Okay, so you need to know roughly how to get that. If you don't know how to get that in Excel, practice it to find out how you put that in Excel. But it's going to be roughly between 50 and 84%. All right. I'm just going to finish this. You did 1 minus probability, so on a standard normal table that shows you the percentiles, negative 0.55. You look that up, or you put it in Excel to get the percentiles, and you write equals normal, standard, normal S dist, and you put the Z. I put negative 0.55, and I want cumulative 1. So the answer of doing it this way, 0.29. So the answer is what? So if you don't know what I'm doing, I'm using the standard normal table. %. Like people were guessing 70%, so they were precise. Okay, your calculator can't do standard normal as far as I know. But if someone knows, that would save time too. So you should be able to draw and guess pretty much. Alan's got it. Yeah, 71%. Okay, so if you don't know that, at least learn how to do it this way. Draw it and make the estimation. So there's some practice in the practice exercises for that. All right, I'm going to move on. What I want to say about these returns is, although there's been stock market crashes over time, one minute. So over 88 years that I've shown you here, there were several incidents of crashes. But on average, with a normal distribution, it's able, or symmetric distribution, we're able to use the arithmetic mean. On average, there's 11% return. So if you left, like if your grandfather, your great-grandfather invested in the stock market and left his investment there, every year, on average, he would have gotten 11% return. Okay? So that's better than the bank account, right? That's better than the less than 1% you're getting on a savings account right now. But it means you have to leave it there because, in fact, there's quite a bit of volatility. All right, but what did we learn here? We learned that the chance of positive returns is about 71%, which is good over time. However, there's a small chance of getting less than 30%, like a loss. A big loss. Okay, so there's 71% chance of getting positive returns, 29% of getting negative returns. So over time, on average, you'll get 11%, but from year to year, there's some variation, and there is a chance of having negative returns in any given year. We compare this asset class to debt. So these are risky, and risk is captured in the standard deviation. When we compare it to other asset classes, so government bonds, for instance, the volatility of government bonds is like less than half. So we're going to use standard deviation as a measure of risk. So when I mention risk, you should think of the standard deviation. That's one measure of risk. And you should think of the expected value as a return. Average return. Okay, so from now on, I'm going to refer to the average as the return and the standard deviation as a measure of risk. And you'll see the higher the return, this is the trade-off, the higher the return, the greater the measure or the metric of risk. So although the risk goes down, the volatility of government bond returns is lower than that of U.S. common stock, the return is also lower. Okay, so this represents return is good. Everyone likes high returns. But the trade-off is it's higher risk. Another asset class, and the more secure, oh, it froze again? Yeah, it froze again. Yeah, okay, let me deal with this freezing again. Thanks for noticing. There you go. So, as I was saying before I was interrupted by this frozen screen, is that we will refer to the standard deviation as a measure of risk. For this asset class common stock, risky assets, as measured or captured by the S&P 500 in this example. The measure of return would be the arithmetic mean. There's a trade-off we see between return and risk. We'll compare it to the government bonds, which on average return 5.2%. So common stock have a better return. However, there's a trade-off. There's also, or unfortunately, higher risk or higher volatility. You see that in the graphs I have here. So though the peak is lower, the returns are tighter. Like they're on different scales, but this is tighter around the mean. This is more spread out. Okay. And for treasury bills, even though they're skewed, this is not highly skewed. They're very close around the mean, with a very small standard deviation relative to the others. In fact, we use treasury bills as a baseline against which we compare other asset classes. And this is the thinking around it. When we think of investors, I lost the connection. I'm back. I don't know why that happened again. Because of that, I'm probably going to lose the chat in the end, so I apologize. I'm not sure what's happening. Okay, so what was I saying? So investors are aware of all of this. They are aware of the trade-off between return, which they like, and high returns. But higher returns are accompanied by greater volatility. They're aware that treasury bills and the T-bills being the least risky, we're going to, in our theory, the theory I'm going to introduce you to, we're going to consider T-bills, treasury bills, to be risk-free. Even though, on average, the standard deviation, of returns is 3.1%, we're going to consider treasury bills risk-free. And so what we're going to say is the rational investor will always invest in T-bills, because T-bills, investing in T-bills protects an individual or investor against, or hedges against, inflation. Okay, so this will, for rising prices, this will retain, or it's like it's a hedge against inflation. So you're keeping up with the rising prices by investing in treasury bills. So investors that invest in other asset classes will need to be incentivized to do so. Okay, because this is risk-free. This is considered risk-free and safe. Because why? Because the government guarantees these returns. Government bonds are are another asset class to which we compare T-bills. So government guarantees T-bills. So when they borrow money from the public in the form of T-bills, they promise or guarantee this return. This is, you can think of the yield to maturity. And they guarantee it to ensure that they pay those returns if they're ever short or they don't think they can pay back or pay creditors, right? Bondholders, T-bill holders, they can raise taxes to raise the money to pay bondholders. So this is the guarantee. Government bonds are perceived as a riskier class than T-bills. They're promising a higher return to incentivize investors to buy those bonds. There's higher volatility as a result. So the return goes up, also the measure of risk goes up relative to T-bills. The difference between the return on government bonds and T-bills has a special name. It's known as the risk premium. And you can compute it by taking the return. I'm going to use I for asset class or whichever one, minus the return on T-bills, which I'll call the risk-free return. Let me do that. Can you read that? Let me try that under the bar. I'm going to write the return to an asset class minus the risk-free is equal to the risk premium. Oh my goodness. I'm trying to put a bar there on top. So that's the average. So that's what risk premium is. So you can compute the risk premium also for common stock. How is that? It's the average return minus the risk-free return, and that gives you 7.9. So this is the formula for risk premium. You can put that on your formula sheet. All right. I looked at different asset classes here on the last page, and I also showed you the distribution. I separated them by, and I also included inflation. I separated them by large company stocks, smaller company stocks, so large company stocks are the most risky with the higher return. Oh no, sorry, small company stocks are most risky with the highest return. Probably should have put them in a different order. More volatility, see, more spread out. So I want you to calculate the risk premium for all of them. I'll give you a few minutes so you can practice that. Inflation doesn't have a risk premium. You don't have to calculate that. But I just wanted to show you that Treasury bills in the States outpace inflation. So investing in Treasury bills ensures that you can keep up with the rising prices. So compute the risk premium for each of these classes and contemplate what you're getting. Okay, give you a few minutes. You can also take a little break. You can ask me questions in the feed if you like. Put your answers in the chat. Okay? Great job. Okay, you did a great job, everyone. Actually, I probably should have put the line here because you don't need to calculate the risk premium for that one. But yeah, so what you've done is you've taken the average, the arithmetic mean for each class, and subtracted by the T-bill average, risk-free. And you've got you've got, let's put the numbers down, right? People have been calculating them, but I'll put them here because we're going to lose the chat stream. That'll be 7.9, 12.6, 2.4, and 2.3. Okay, so the greater the return, the higher the risk. It's pretty consistent. Good job. So I want you to do it because I want you to remember. Don't forget what the risk premium is. So the interpretation is, theoretically, this is the way it works out, because to take on greater volatility, investors will require a higher return. Greater volatility, higher return. So even you see it even here, right? This is more volatile. No, it's actually, this is more volatile. Lower return. Oh, wait. It's almost the same. In this case, you see higher return between these two with the higher risk. So there is a pattern, but it's not perfect. The next question I want to ask you is, why don't I put a bar on the risk-free rate? Why is there no bar on there? Is that just a coincidence? Did I forget? Why is there no bar? Anyone, why is there no bar? In other words, why am I not averaging? Why am I not averaging? Anyone? Okay, because it's not an average. Yeah. Close. Good, Al. Okay, so the risk-free, there's another thing I have to tell you about the risk-free rate. Yes, but Al, there is, okay, so T-bills, the risk-free T-bill changes over time, right? There is some change. The return changes over time. That's what we have here. That's why we have some variation. But what we assume is that it's risk-free. What we mean is that there's no, even though you see it over time, we assume the standard deviation of T-bill returns is 0. So if there's no variation, it means the number, the T-bill, the returns are always the same over time, then you can't have an average. So you were close, Al. Right, you got it. The average the numbers will be the same all the time because the standard deviation is 0. This is the idea of risk-free. No risk. 0 standard deviation because standard deviation captures risk. How's that? So you need to remember all this. You need to remember this formula, put it on your formula sheet, the risk premium, and also that the risk-free return sigma F, or sometimes I'll say sigma T-bill, is 0. Okay, so you need to remember those things. This is an F. This is an F here. Sorry, this is an F or T-bill. I can say either one of those. The subscript. Yes, Kyla's asking, the standard deviation is 3.1, but theoretically, well, you're going to see that I'm going to do this. I'm going to refer to the T-bill as risk-free because it's the lowest. Okay? We're going to just assume there's the standard deviation is 0. Okay? So this is, empirically, this is what you see, but the theory I'm going to derive is I'm going to assume T-bills are 0. I'm just jumping to the chase, okay? This is jumping to the end. Okay? So you need to remember that. Sure, this is empirically, that's what you see, but because it's the lowest, we're going to say, well, relatively speaking, it's risk-free. Like, look at these. These are much higher than this one. Okay, good questions. We're done with this set of notes. So what you need to take away from that are the formulas I mentioned, the percentage return formula, the percentage change formula. Actually, maybe I'll tap through it. So so I've squared the formulas off that you need. So the percentage return formula, you need that. You should know the dollar return, which is just the numerator. You should know up here the percentage change formula. You should know the dividend growth model, which is this. That comes from this, which is a more specific case of the general case for the percentage returns. Those formulas you should know. Obviously, this and this and this. But anyway, you need these formula. What else? You need to know that common stock are approximately normally distributed over time. And you need to know the risk premium formula. And you need to know the risk-free has a standard deviation of 0. Okay? That's my summary for that. Obviously, you need to know how to calculate mean, standard deviation, all those geometric average return, those formula there, holding period return. So you get practice on that with the exercises I gave you. Okay. We have another hour and a half because I'm going to go over half an hour. I missed a half an hour. And if you can't stay, you can go and come back and watch the rest later. I need 5.8. No, that's not what I need. What do I need? Let me see. So if you didn't get all that, that's okay. Just review the videos and let me know if you have any questions. What I need to do is give you, I gave you 5.9. Did I give you 5.10 and 11? So what I want to share with you, we're going to discuss 5.11. Do you have 5.11? Do you have 5.10? Oh, here it is. 5.11 is here. Okay. Oh, I didn't send 5.10. Okay. Well, prepare 5.10 for the lab tomorrow, okay? Do your best for the lab tomorrow. I will share the solutions. I'll share them tonight, and but try not to look at them unless you've actually attempted the problems, okay? So I will send you 5.10. So let's look at 5.11 right now. Okay, so this is 5 point. Now, how many of you read this? This is 5.11. How many of you read through 5.11? Okay, Spencer, thank you. I'm going to go through this. Just want to know how many of you actually looked at it, if anyone looked at it. Okay. So there's lots more statistics in here. And it's depending on your comprehension of the review. Let me know if the screen freezes. Yeah, I can believe you got confused, Tanner. All right. So I'm going to spend the rest of the class on these. And like I said, I will go an extra half an hour beyond 9:45. So I will be here till 10:15 or longer to get through these. All right, let's see. So risk and return. Risk and return and the capital asset pricing model. All right, so this is where we're headed. Capital asset pricing model, and then to WACC. This is where we're headed. So what did we learn? We learned about risk and return. The higher the risk in general, higher risk is associated with higher returns. Or I should say that the other way around, right? To be compensated for a higher risk class of assets, investors require a higher rate of return. So in efficient markets, where you have market clearing forces. Assuming perfect information, this is the theory. Investors need to be compensated for taking on additional risk with higher return. If an asset, so if a corporation can't guarantee that or can't secure a higher return, that company risks failure, okay? And that asset won't exist anymore. So that's where we're headed. That's what we're going to talk about. If you didn't understand anything I said, it's fine. That's going to be the conclusion of what we're talking about. Okay, so let's look at this. To make good value maximizing or financial decisions, one must understand the relationship between risk and return. We accept the notion that investors like risk but dislike returns. What did I say? I was reading a text. Sorry. We accept the notion that investors like returns and dislike risk. It's right here. They like returns, but they dislike risk. All right, so as a proxy for return and risk, we will use expected return, which should be an average of the distributions of possible returns. Now, until this point, we have been using historical data, right? Ex post. But for this unit, or this module, or this part of the module, we're going to focus on ex ante returns. Now I could do this also with historical, but I think we want to squeeze it in and talk about ex ante data. Remember what that is. Though that's a distribution. I actually give you a distribution. And I give you what we call a discrete distribution. Just 2 or 3 or 4 states of the world. In the exercises, in the homework or the problem sets I give you, I could give you more. So expected returns, because the data are ex ante, it's a weighted average of the distributions of possible returns in the future. And the variance of returns is a measure of the dispersion of the distribution of possible returns in the future. So it measures the volatility or the risk, and the return is the weighted average. So as a recap, because we did do this, I did give you the notes on this. Here are data. There are 3 possible states of the economy. Now, these numbers were determined by looking at prospectus for the company that was established by looking at the industry that you're in, and the competitors in the industry, and market forecast. And it turns out, using historical data, all the data available, we put together this discrete distribution. And it's discrete because there's only 3 possibilities. So as much as this may seem complicated, it's actually a simplification. Either the gross national product, so a return of productivity, a healthy state of the economy, a positive 1 change might occur. So this is anticipating either a positive 1% change with 25% likelihood. If that happens, these are the returns anticipated for stock in company XYZ. Negative return. So this is not great. Okay, so this is not great for the stock. In a 2%, in a condition of expansionary, or let's say this is a normal state of the economy that has 50% chance of occurring, the returns to XYZ Corporation are 15%. And in the best case scenario, which has 25% chance with 3% increase in the gross domestic national product, we will have more than double the returns that were in the normal state of the economy. In this expansionary state, we anticipate 35%. Okay, so we treat this as a discrete distribution. And from there, we can calculate, as I showed you in the example, the weighted average, the weighted average returns. How do we do that? We multiply, so you should practice if you don't know how to do this. For ex-ante returns, we use the weighted average. So you multiply the return by its weight. You pre-multiply because each one has different significance. The 15% is the most significant, and it turns out when you put it together, the weighted average becomes 15%. So mathematically, let's do this together. You can fill it in. It's for practice. This is negative 0. Well, I have it as percentage, so why don't I write it as percentage? So that's negative 1.25%. Let's use decimals. I'm going to use the decimals. So it's negative 0.0125 for the recessionary state, or of the economy. The normal state of the economy, 0.5 times 0.015 is 0. So this is might be a little confusing for some people that you're multiplying a percentage by a percentage. Just keep track of what you're doing by not writing the percentage down. It's all decimals. So 0.25 times 0.35 is 0.0875. And then because you've already put the fraction in, you don't have to divide by 3. You've already done that. You haven't divided by 3. You haven't given them equal rate of 1/3. What you've done is given them different weights, but the weights sum to 1. Which is really important. It's critical. So when you add those together, I think we just buffered a bit. So when you add those together, you get 0.15. Did I make a mistake? It's possible. 0.5 times 1.5. I made a mistake here. This is going to be 0.075. That's the only way it's going to work. So this is 0.075. My apologies. I don't know. You're watching a live stream. I apologize. It's not a perfectly edited video, but there you go. So if you add those together, you get 0.15, which is 15%. Okay? So that actually is the normal state result, the middle result, 15%. And that happens because the chance of 15% is 50, and the chance, there's equal chance that it's going to be a distance lower or the same distance higher, right? So it works out to be 15% when you average it. All right, so that's the ex-ante formula for average. What about the variance? And clearly we had to assume symmetry here. We're assuming symmetry to do this. What about the standard deviation? Remember this formula. So I promised you the notation is going to look a little bit different because I have R's, but this is just the same as I asked you to work on the weighted variance and standard deviation formulas. I gave you some exercises to practice and I gave you the answers. So you should be able to calculate this. I think I give you a table here on page or slide 5. So this can help you. You can set up a table where these are the deviations from the mean squared, where the mean we calculated as 15%, right? So notice the notation. This is just like the mean. We write it like a mean, and we say this is 15%. And then you square all the values, and then you pre-multiply all of them by their weights. So you have to take 0.25. Again, you can do this in Excel to make it easier. So what I've done is multiplied this by this to get that. So if you set up your table like this, you'll get the same answers. So this one is easy because this one just ends up being 0, right? Because that middle one was exactly 15%, and that was the mean as well. And then the last thing is 0.25 times 0.04, which is 0.01 as well. So this ends up being actually an easy calculation. It's not a big deal. So you have the variance is 0.02, but we remember we have to take the square root of that. So the square root of 0.02 turns out to be the standard deviation of 14.14%. So what we have in conclusion is a mean of 15% and a standard deviation of 14.14%. That was just practice, okay? We were just practicing making these calculations for ex-ante returns because that's what we're going to focus on. So these are the returns anticipated, and I've summarized the data or the distribution with its mean and standard deviation. The expected return is 15% with a standard deviation of 14%. You could assume normality. No, actually, sorry, this is just one stock. So on the basis of just one share, one stock, not several, this would be the mean and standard deviation. So it's the case that even though I made these calculations for one company stock, the truth is investors hold a combination of securities in a portfolio. And the rationale for this will be clear if you don't already know. You don't want to put all your eggs in one basket. You don't want to invest just in one company, okay? As an investor, you're going to want to hold securities to minimize risk. So let's see, what am I talking about? Here is my example. So a portfolio is a combination of securities. So imagine we have two securities. We have security asset A and asset B. So we're talking about stock here, okay? I could do this for other assets as well, but think about it like that, because then you can think about how I calculated the returns. Okay, Kyla's asking me to interpret. Let me go back a bit. So, yeah, this is still, you can interpret, you can do this and talk about, you don't have to say it's normally distributed, but you could say most of the time the returns will be within this range. So you could say even if it's not normally distributed, you could just say most of the time. But you'd have to assume some sort of symmetry to be able to do this. Do you understand what I'm saying? So you'd have to assume symmetry, and then you could say most of the time the returns will be between here and here. So what would that be? That would be about between 1% and, right, so 15 minus 14, so 50, I'll use the decimals, minus 14.14, right, is 0.86%. This is going to look messy. I don't like it. Let's put it... Okay, Kyla. It's a good question. You guys are asking great questions. So if I was to calculate this, it's like, I'm going to just estimate. Because it's going to be messy. So I'm going to say between 1% and like 30%. That's plus and minus, using what we learned before. Okay, so that's how you interpret mean and standard deviation. And most of the time the securities between, so it's positive. Most of the time you'll have positive returns. They're low, but they're at least positive. You didn't lose anything, okay? Most of the time. All right, so now back to what we were going to do. All right, so there are two assets now, and I'm going to include them both in my portfolio. I'm an investor, and I want to know what is the return to the portfolio. I'm going to begin by using the information given, and notice I just give two states now. So imagine the normal case is not going to happen. I think 60% chance of a depression or recession, a bust economy, and 40% chance of an expansionary economy. So it's more likely that things are going to go sour. Here are my expected returns in either case. Now I need to combine those to come up with the expected returns to A and B. And I use the weighted average again. What's the weighted average? Remember, I have to multiply. I got to multiply this times this plus this times this, right? You have to pre-weigh them. Weight times score plus weight times score, and you get 6% for acid A. And for acid B, when you figure it out, 0.4 times negative 20%. Notice I'm using decimals, okay? And then 0.6 times 25%, 0.25, and you add it together. So this one is 7%. So take a moment before I continue and tell me about the relationship between A and B. What do you see? Well, how can you describe the relationship between A and B? What would be one or two words that would describe the relationship between A and B? Okay, that's more than two words, Kyla, but that's correct. One goes up and one goes down. When one goes up, one goes down. Perfect description. What's two words to describe that? Close. No, I want a finance word or a statistics word. Or two for statistics words. Come on, you guys are so close, but I want you to use statistics terminology. Okay, one word starts with N, and the other word starts with C. Aha, Ben, thank you. Negatively correlated. You guys were great, though, for trying that. So negatively, they are negatively correlated. Negatively correlated. Okay. Okay, so negatively correlated. When, and as Kyla explained, when acid A does well, acid B does poorly. When acid A does poorly, acid B does well. Very important. So how does this affect things? Why is this so important? What's the big deal? Well, for now, on average, acid A returns 6% and acid B 7%. What about their variance or standard deviation? Here's the data again. You can calculate, so you should practice this, okay? Practice, it's just two states of the economy. So you have to do the deviation, average deviations from the mean for a weighted average. You have to do the deviation from the mean squared for both and pre-multiplied. I've put them lengthwise because that's how they fit on the slide, but I prefer you to do them in columns as I did in the handouts for ex post and ex ante returns. All right, so these are the variances. Now I have to take the square root. So A has 19.6% standard deviation or measure of risk for individual security, and B has 22% as the standard deviation. So in summary, I've put everything in the slide below. In summary, the return to acid A is 6% with a standard deviation of 19.6, and acid B has an expected return of 7% with a standard deviation of 22%. So which acid do you prefer? And what do we see in the pattern of assets? What is the trade-off? Is there a trade-off here? What's the trade-off? Notice B has a higher return, but it also has a higher risk. So what would the average investor do? The average investor is considered risk averse. A rational investor considered risk averse. A risk averse investor, when presented with two securities with comparable returns, will choose the lower risk security. Risk loving investors, when presented with two securities with comparable returns, will choose the higher risk security. Now they're close, but they're not the same, right? So we have a situation here. How will we deal with this? And I suggest using this measure that I did mention in the notes. I didn't talk about it, but I mentioned this measure in statistics known as the coefficient of variation. This will help you. It will help you make the comparison in the midst of the trade-off, when the trade-off exists, okay? We can't just pick one outright because these are not exactly the same return. Instead, we compute the coefficient of variation. So what are we going to do? We're going to take the risk for A, and we're going to spread that risk over each percent of return. So for each unit of return, I calculate an index because, you know, this is a percentage and this is a percentage, right? So when you take a percentage divided by a percentage, you end up with an index. This doesn't have any units. This is just an index. And it says the index is 3.2. So it's saying that there are 3.27 units of risk for every percentage of return in asset A, for asset A. So that's more risky than B. B, if I take the, so I'll do this again if you didn't get it, I'm going to take the measure of risk, 22%, the standard deviation is 22%, that's my measure of risk. I'm going to divide by the expected return, and I end up with an index. So for each unit of return of B, the level of risk is 3.14. So a risk-averse investor, one who doesn't like risk, would choose B because it's lower risk over A. And a risk-loving investor who would perceive these as comparable returns, you know, some people would argue, they'll choose A over B. I don't know if that's true now that I'm looking at it. Hold on. Well, as I explained here, when presented with two securities with comparable returns, they'll choose the higher risk security. If we indicate. So if I ask you a question and I ask you to use the coefficient of variation, you could say that A is the higher risk security and pick A over B. So that's what I'll say for that. So this coefficient of variation is what you'll use when you have a risk-return trade-off that is clear or apparent. Okay, so again, this is not exactly, we don't just pick between securities. We don't exactly do this in finance. Investors will hold a portfolio of assets, and we're focused on risky assets right now. So we want to learn how to combine assets into a portfolio, because all I've done so far is spoken of the assets individually. Okay, I haven't combined them yet. And I've talked about choosing between them. What if I combine them? How do I combine them? Okay, so this is a little bit different. I didn't do this exactly in the review. What we're going to learn about now in statistics would be called joint probabilities. This stands for joint probability distribution. Okay, what we're going to do in our calculations is use the theory of joint probability distributions and the rules of means and variances. Now, I'm not going to go far into teaching you that. I'm just going to show you how to combine two and more assets into a portfolio and solving for the mean and standard deviation. So here's an example. Don't let this intimidate you. What is this? What is this? What is this in a few words? In 2 words. Yes, the weighted average. This is the weighted average it's the weighted average return. Okay, that's the weighted average. Look, here are the weights that are known as, this time we're going to call them the proportion, and I'll tell you what that is in a minute. And these are the returns. The expected return. Okay, so I've shown you here N, so it could be 5, 10, 50 assets combined in a portfolio. I'm going to begin just with 2, okay, to make it easy, and then I'm going to show you how to scale it, how to put more assets together. So here's an example. Bear with me, I know it's 9:30. And people have to go, you can go, but I'm going to finish some portion of the notes. I'm going to go till 10:15. So consider a portfolio with 2 assets, asset A and B, and we're going to use the data from above. 50% is invested in asset A and 50% in asset B. So let's say a total of $1,000 was invested. So that means 500 went into A. Okay, so you purchased $500 worth of A, and 500 went into B. that would be 50% each, right? Got it? So I could tell you in dollars, or I could tell you in percentage. The formula uses the percentage, so you need to put these in. So if you have 50% of each, this is going to be, so I'll use blue, 0.5 times, what was the return on A? What's the expected return on A? So we're using expected returns. 6%, right? Let me do this again, it's a little messy. So I'm going to use this formula. This is the weighted average return. So it's the weighted average of the means, right? So this is 0.5 times 0.06. It's still too big, isn't it? Let me make it there. So this is 0.5 times 0.06, and this is 0.5 times 0.07. So when you have 0.5 and 0.5, it's like averaging, right? It's the same as just 6 and 7 divided by 2. 6 plus 7 divided by 2. So what would that be? So you could just calculate that, you know, multiplying this times this plus this times this. But I know the answer is going to be halfway in between the two, 6.5%. So what you figured out is the weighted average of the averages is this. So this comes from rules of means and variances, where the average of two distributions now let's say it this way. Now that it turns out that, and you know, I'm going to avoid getting too deep in statistics, but basically it's the case that the average of a combination of two distributions is the weighted average of their means. And the weights, remember, the weights are not coming from states of the world now. These weights are from relative contribution or proportional contribution to the portfolio. So 50% was spent on A and 50% was spent on B. So they have equal representation in the average. Okay, let's get the variance. Now you're not going to like this too much, probably, but I'm going to try and make this interpretable for you. It turns out that even though here where this is the mean, or let's say So the expected value of a combination of assets Al's asking for an extension before the class is up. Yeah, I think you probably need an extension. I can probably give the extension till Saturday, right? Because you should know everything by then. Yes, I know, Harper. I have to see. I have to double check how far that assignment goes. And how much I've covered. Okay, so I'll let you know. I'll email you guys about the extension. If it's going to be Saturday or if you need more time even. Okay, back to this. So the mean, this is like the expected value, the mean of the combination of two assets is equal to the combination of their means. That's really what this is saying, okay? The mean of the combination of two assets is equal to the combination of their mean. Is that all right? Do I have to write it in words? Write it in words. So I said the mean of the combination of assets is the same as the same combination but of their means. So what you do to a distribution, you also do to the means. So if you're going to combine them like this, then the means are also combined like this. Oh, you're right, it's froze. Okay, let me redo this, and you guys can see what I wrote. I gotta fix that for you for next class. I'm gonna just reboot the system. That helps. Okay, there you go. Now I'll repeat what I said. The mean, or the expected value, right, of the combination of assets is equal to the combination of their means. So what we do to the distribution, how we combine the distributions, ends up how we combine their means. So if we're gonna combine them like this, the distributions, we also combine their means like that. So what you do to the distributions, you also do to the means, right? Because they're the center of the distribution. Is that okay? That's actually, as complicated as that might seem to some people, that's actually very simple. It's a simple result. And so now we're going to talk about the variance and see if it's the same pattern. So let's see. I'm going to write that down again. Remember, how did we combine the distributions? No, I didn't want to write that. Remember, R is the variable. So there's RA and RB. So let's see, is the rule the same? The combination of the variables XARA plus XBRV with a variance. What's going on here? So remember the variance, what it does. What is the how do we calculate the variance? Remember, it's the square deviations from the mean. So we squared all the units. Remember, we squared all the units and we had percentages squared, right, when we calculated the variance. So if there's a weight in front, we're going to have to square the weight. So notice this part of the formula. What does it mean? It shows you that the variance of the combination of distributions is just the combination of the variances. So it's kind of like the expected return. Let's look back at that. So remember, the combination, the pattern here of the distributions, combining them in this way, when you take the expected value, is just the same combination but on the means. So whatever you do to the distribution, you do to the means. Is it true that whatever you do to the distribution, you also do to the variances? Well, this part of the formula says yes. Look at this. This is the variance of A, and this one is the variance of B. And because I have to square all the units, I also have to square their weights. All right? You guys okay with that? But what the heck is this? Where does this come from? Does anybody know? Can someone tell me what this is? What does this mean? If you reviewed the statistics, you would know what this means. The handouts that I gave you. So this is, I promised you that this is going to look annoying, but you have to reduce it yourself. Like, you have to realize this is just the covariance. Okay, this is the covariance of A and B. Where does this come from? Well, if it turns out that the covariance of those two returns is not equal to 0, then you have this extra term. This extra term is all of this. But if there's no covariance, or in other words, there's no correlation between returns, then you just get this part, which says whatever you do to the distribution, you also do to the variances. So where does this extra term come from? Well, it arises when there is some correlation between them. All right. So in our example, what did we say? With A and B, we know that they're negatively correlated. When you calculate the covariance, which you're going to do, you're going to practice that for this data, the covariance actually turns out to be negative. What I want to take a moment to do, and if you have to leave, goodbye. The ones who are still here, you can let me know if you have any questions. I want to derive this formula for you, and the reason I do that is so that you can see how we would possibly combine more than two securities, okay? I'm going to do that on a blank page. And what I'm going to do is I'm going to combine more than, I'm going to use a different color because Muskan asked me to use a different color. And I'm going to combine asset A returns with a weight in front of it. With acid B returns and I'm going to consider all the components of volatility. So what I'm going to do is I'm going to create this matrix. And I'm going to say combine returns of acid A, the volatility of returns of acid A with acid A. What I'm going to do is say, make this a bit bigger. I have to do that again. I'm going to make it even bigger so I have more space. Okay, you get what I'm doing? So I'm going to say, let's calculate the covariance of returns of A with returns of A. And now I'm going to combine the volatility. Oh, I have to make it bigger again. Of returns of A with returns of B in combination, right, with the relative weights, where the weights sum to 1. And then I'm going to do B with A and then B with B, okay? So you're making a matrix, you're copying this down. If not, you're going to do it later. All right, so this is what I've done. I've considered the components of variation contributed by each security. So I've considered A's returns, A with B, and I've had to do it 2 ways, right? And then B with B. And what does that tell me? What does that give me? What is this? What's the covariance of A's returns with itself? What does that give me? Does anybody know? Now, to avoid making this so messy, I want you to think about the covariance formula. Just think about the covariance formula for X and Y. Forget about all these R's for a moment. Remember X and Y. Let me make this bigger down here. So covariance of X and Y is equal to, if we use the x post calculation, right, which we could, it's x minus x bar. Remember this? And y minus y bar. But what if we had covariance, and I'm going to make it look more like what we have above. What if it was with a weight in front of x and the same thing x? What would that be? What would that look like? That would be like ax minus ax bar, right? Because the a goes to all the units. That's what this does. The a goes to all the units. And then because it's just another ax minus ax bar, it would be like that. Those are small x's, by the way. So what's this? Could somebody tell me what this is? So this is going to show you, I'm writing it this way because I think this is the more intuitive, well, it's for me, it's the more intuitive formula for covariance. What is this, everybody who's left? What can I do? Can I factor out an a out of each of these? And factor out an a out of this one too? It's just a scalar, it's just a constant. I can move it out in front, right? So what am I left with? Are you with me still? Don't fall asleep. Does everybody agree that that's what's left? Oh, I missed the square. So you see how by putting a number in front there, so what is this saying? It's saying multiply every value of the variable x by a. So that's going to affect every value. So every single value will be pre-multiplied by a. And the mean, from the rule I told you before, will be pre-multiplied by a as well. Because whatever you do to the distribution, you also do to the mean. I do that twice. But then I have a squared. You see how this happens? So that's where the square comes from. And now what's left over? What is this? What is this called? Any one of the 17 viewers, what is that called? Anybody answering my question? Close in a, not standard deviation. What's the answer? It's the standard deviation squared. It's the standard deviation squared. This is the variance. I'll write it like variance. Okay? So what I'm trying to tell you, from this description, yes, that's good. From this description, let's finish this now. So what's this? I want you to see the pattern. What's this now? I really hope this exercise helps you understand how we combine many securities. What's this? Give me a name. So notice below I use the X, this was for X post, right, for historical data, but how do I do it with the ex ante data? What would be my answer? You guys are tired, I know. I'm pumped. I get excited when it all comes together. Is everybody good with that? So this is the variance. What's missing? So as you look at the pattern that I wrote below, I'll flash it again. Let me show you again. The covariance of A times X with A times X turns out to be A squared times the variance of X. So, because the units are squared, also any kind of weights will be squared, right? Because we do the squared deviation from the mean. So the weight will be squared times variance. So the same thing up here, the weight gets squared times the variance, and that's my symbol. This portion will become xb squared variance b. So remember, when we combine A and B to get a new RP, that's what we're doing. We're creating we're creating a portfolio of returns, which is a combination of A returns and B returns. And I'm trying to figure out the mean, which I did. Whatever I do to the variables, I also do to the mean. And the variance, whatever I do to the variables, I also do to the variance, but there's a slight adjustment. There's these extra terms because the variables interrelate. The interrelationship creates these extra terms. So what are these? Are these the same? Is the covariance of A XARA and XBRB the same as the covariance of XBRB and XARA? Are these the same thing? Yes, they are. And so what is the result? They would both be right, Harper? They're the same. So this one is going to be XAXB, and I can write it. If you think of the formula, it doesn't matter for covariance formula. It doesn't matter if I put X first or Y first. So in the same way, it doesn't matter if I put, for covariance, it doesn't matter if I put A and then B or B and A. It's the same thing. So each one of them are XAXB covariance. Oh, the symbol that I'm using, remember I use the Greek letters because these are distributions. Sigma AB. And the one here is also the same. XA. So how many of them do I have? So these are the components of variability for this newly created variable. There's the weight squared times, so whatever I did to the variables when combining them, I do to the variance plus this extra term, which is just two of these. So that's where the formula comes from. Two of these, one, this and that. So if you didn't get it, you can watch it again later. That's where that formula comes from. Okay, so if you ever get confused, make the matrix and remind yourself there's two components of XA, XB covariance because there's a relationship. If there's no relationship, if they're not correlated, this last term disappears and you just have this piece. It's just the sum of the variances because whatever you do to the variables, you also do to the variances. All right. I'm going to continue. From here, once I have all of that calculated, all those pieces, and I put them together, I need to get the standard deviation, so I have to take the square root of that, because that was the variance. Take the square root, and that's the square root of P, the portfolio. So the only thing that remains is we have to compute all these pieces. So you need to practice with these notes, computing all these pieces. Don't just read this passively, okay? Compute all the values. This looks really scary and intimidating, so you need to practice so it's not. All it is the covariance of the returns. The weights are just out here. The weights are out here, so you just multiply it by the weights after. Okay, let's see. Let's try and do this. We already have the variance for the securities A and B, right? So we have this number. We have this number. We know these because it's 50-50. So we have all those numbers. Just don't forget to square things. And then at the end, we have to take the square root. So all that, and we have this. That's 50%, and we have that. So we have lots of stuff. The only thing that remains is, what is this? So I have the formula above. You should practice calculating it. And when you do, verify this for yourselves in your homework. This is your homework. This is the covariance. And as we suspected, remember, A and B were negatively correlated, and there it is, negative. You get a negative. Okay? So work with this, repeat this, do this on separate pages and practice making these calculations. So once you put all of this together, because they were correlated and negatively correlated, let's look at the take-home message here. The take-home message is that by holding the securities in a portfolio, whereas the variance of A and B, remember, what was the variance of A and B? Or sorry, the standard deviation of A and B. The standard deviation, let's go back just to see that. If you they're here, right? So A had a standard deviation of 19.6% and B had a standard deviation of 22. When you combine them, because they're negatively correlated, when one does poorly, the other one does well. So this is a hedge. This is an example of what's called a diversified portfolio. When one does bad, the other one will do well. So this is an example of diversification, and I see it. Let me do that again. I see that in the fact that the standard deviation of holding those two securities in a portfolio the standard deviation is 1.22%. Can you believe that? Okay, so you've reduced your risk by coincidentally holding those two assets. And this is the take-home message. All because of that negative. So in between this presentation, you need to understand this, but also you need to be able to compute these pieces. So I want you to practice that for homework. Make this calculation on separate pages. Okay, what I want to do is say one last thing of more than two assets, one more point. If you have more than two assets, this scary formula means use the matrix. The matrix. Make a matrix. So if you have more than two assets, this is saying how to combine them. Think of the matrix. Think of all the possible combinations of the securities. Taking them two at a time. Because it's a matrix, it's two-dimensional. So what do I mean? What I want you to do is take X A, R, A, and this is just for homework too, X, B, R, B, and X, C, R, C, and combine all of these as we did with just two. And consider A with itself, A with B, A with C, and all the possible combinations two at a time. What you're doing here, this would be a portfolio. This would be a portfolio of, oops. In this case that I've printed, the portfolio would be XARA plus XBRB plus XCRC. So combining three securities at a time. What would be the variance? Can someone guess? If you think about what we just did in the pattern, what would be the variance? You don't have to use the matrix to prove anything. It's just for you to realize what the formula would be. So what would be the formula here? It's going to be hard to write here. Oh, someone asked the TA to send the marked second test. She will. She'll send it. Well, I didn't put any numbers here, but I mean the formula. What would the formula look like? Can someone write it out? Come on, somebody. So what was the pattern here? It was whatever I did to the combination, however I combine the variables, I also combine the variances, and remembering that variance squares all the units, right? So it squares the weight as well. So this is the weight squared variance of A squared, weight squared variance of B squared, plus 2 of these. Okay, Senna wrote something. Okay, very close. So this is the question. What is this going to be for 3, and what are the exponents going to be for 3? Notice, because of the pattern, I always take 2 at a time. I'm only taking 2 at a time. So it turns out, if I filled this all in, and you can prove it to yourself, the variance would end up being xa squared still, sigma a squared, plus xb squared, sigma b squared, plus xc squared, sigma c squared. So it's going to be squares, so that's what she got wrong, but then she had something else there. And then I have to think in pairs. It's all in pairs. The matrix forces you to use pairs. But it turns out, so that's the diagonal. I just showed you all of these down here. That's not very good, is it? So I've shown you this one, and this one. But off diagonal, the covariance of this combination would be the same as the covariance of this combination. So there's 2. There's going to be 2 of each pair. So I'm going to write it, and then you guys can just justify it. Okay, so I know it's late. You can just figure this out. Think about it. So that would be in each combination. So it would be 2 xa, xb covariance of, oops, no, I'm going to use the symbols, right? Sigma ab plus 2 xa, xc sigma ac plus 2 so then I can go into the B's. XB XC sigma BC. And where am I getting that from? Because it's going to be this one and this one, right? This one and this one. You see the combination? So that will be XC XB sigma BC. And that just leaves this one and this one. So think about it. The point is it's in pairs. So the formula turns out to be, and that was the big thing, is the exponent going to be cubed? No, it's just going to be squared. It's just like before because we have the diagonal terms on the matrix. The matrix is two-dimensional. So it's just going to be squares and variances, and then these would be the contributing covariances. So you have to put together A with B, A with C, and then B with C. And that takes care of it. All right? So I need to show you that. You can make this a huge matrix, but again, this is not a stats course. I'm just trying to show you what in the world this means, this formula. It means combine them in turn. And the matrix facilitates that combination. So think about this. Woo, sorry. So think about this. The most important thing is that you do it in 2 dimensions for this class, okay? But I just want to show you, in case you come across it in reading, you know what this means. All right. So it's 10:14. What I will do is pick up here. So work with the notes. Study. So tomorrow the focus will be on everything till this moment. Okay, so lots of computations for you. And we'll get more into this concept of diversification, portfolios, and what's known as systematic risk and unsystematic risk. All right, so that's what we'll pick up with on Thursday. So I'll finish these notes on Thursday. And we'll talk about, we have lots to do. I'll do some exercises with you, and I have a new set of notes as well to give you. So I'm going to send some exercises for practice. I'm going to send the solutions to 5:10. No, sorry. Well, the solutions to the problems I sent you. And that's it. So if you have any more questions, I will just get back to you. Or you want to see my matrix? I will get back to you with answer about the new deadline for the assignments. I have to see how far I go. All right, so have a good night. Thanks for sticking around. And let me know if you have any questions. I'm going to put it like that so you can see it all. I really appreciate your efforts at writing the formula in the chat. You did a great job. I'm going to take a screenshot of that. Good night.